Hi, I'm Christian Maloof, founder of Capital Clarity. I've spent the last 15 years inside the banking and mortgage industry, working with brokers, lenders, and credit teams across the country. I've seen how banks think, how they assess customers, and why two people with the same numbers can still get completely different outcomes. My mission is simple: to give everyday Australians the clarity the industry never taught them, so you can make smarter decisions, avoid hidden pitfalls, and genuinely put yourself in a stronger financial position. Welcome back to Capital Clarity. Today, I'm giving you the insider playbook every Aussie should have been taught. Newsflash, the banks don't treat everyone the same. Not because they're evil, but because they're very strategic. Like any business, they balance supporting customers with managing risk and delivering returns for their shareholders. When you apply for a loan, you think it's all about your income, your credit score, and your expenses. But behind the scenes, there's a completely different decision-making engine. Today, we're breaking down the 3 layers of how banks actually make decisions, including customer value score and how you're segmented internally. And then I'll show you how to become the kind of customer banks actually compete for. Now to the decision-making pyramid. Banks use 3 layers to decide if you're a yes, a no, or a not yet. Layer 1, policy. The black and white rules. Minimum credit score, buffers, borrowing limits, employment requirements. This layer is the same for absolutely everyone. Layer 2, appetite. This is the secret layer, the one you never see. And like pricing, it changes weekly, sometimes even daily. It's shaped by things like portfolio performance, regulator pressure, arrears trends, industry exposure, and the types of customers the bank is targeting that particular month or half or quarter. You never really see appetite written down, but it quietly drives everything. Layer 3, human judgment. Yes, real people still assess parts of your file, and this is where clarity, structure, and presentation truly matter. The unwritten driver, risk appetite. The risk appetite is basically the bank's mood, but backed by data. High appetite, approvals flow. Low appetite, borderline deals get declined, and everything tightens. Timing really does matter in this game. Banks constantly ask 2 particular specific questions. 1, can you repay? And 2, are you valuable to them? Your credit score answers the first, your value score answers the second. A value score, you're thinking, what the hell is that? Well, let me explain. A value score looks at things like salary credits, savings patterns, card usage, and future potential. And whether you cost or create value for a bank, this score determines who gets escalated and who gets quietly declined. 2 people with the same job, same income, same suburb, and same credit score can still end up with completely different outcomes. Why? Because of things like appetite, value, timing, statement quality, and deal structure. And even the channel you apply through can change things. It's not about fairness. It's about alignment within that particular bank strategy. So how do you make banks fight over you? This is where we flip the script. Before the tips, here's the real truth. If you're the kind of customer a bank is actually looking for, everything becomes easier. You get clearer options, faster assessment, better alignment, and a smoother, well-rounded experience. Tip 1, clean up your digital footprint. Banks analyze statements like detectives. Make your story clean. No late fees, no gambling spikes, no messy transfers. Reduce afterpay and avoid 5 food delivery transactions every week. Tip 2, show stability. Banks love stability. Consistent salary credits, paying cards in full, low credit utilization, regular savings, minimal credit inquiries. Consistent behavior builds their confidence in you. And tip 3, apply the right bank at the right time in the right format. This one is huge. Not all banks want the same customers at the same time. The right bank at the right moment, presented the right way, can be the difference between an approval and a sharp rate or a decline, simply due to misalignment. And this leads directly into tip 5 below. Let's cover tip 4, become a high value customer. Simple habits make the difference. Salary credits, a savings buffer, responsible card usage, a clean transactional history, and financial predictability. Banks love customers with clear, consistent patterns. and they really love deposits. If you're holding large balances in your bank account, they definitely don't want to see you banking anywhere else. And tip 5, use a broker. A great broker helps you face into a bank with clarity, structure, and strategy. They have multiple lenders with multiple products and multiple pricing models. They match your situation to the right lender's appetite at the right time. They package your file, tighten your story, remove landmines, and escalate when and where appropriate. This alone can ultimately be the difference between a smooth approval or a decline due to poor presentation. Brokers also follow a legal obligation called the best interest duty, which ultimately means they must do a number of things. 1, act in your best interest. 2, compare you with multiple lenders. 3, justify recommendations. 4, avoid conflicts. Bankers represent their bank, brokers represent you. I spent years working closely with brokers across the industry. If you want help finding a great one who genuinely puts customers first, drop me a comment and I'll point you in the right direction. In closing, the banking system isn't evil, it's just really complex. Most people never see the playbook. My job is to give you clarity so you can navigate it confidently. If you found this helpful, click the subscribe button. There's plenty more good content to come. I'm Christian, and thanks for listening.